Topic of our conversation is, are low long-term rates here to stay, and the Fed liftoff versus downward pressures on long-term rates. What we're observing currently is the 10-year U.S. Treasury rate. What we've seen in January 2015, it hit its bottom of 1.68%, and this low rate hasn't been observed since really the Federal Reserve conducted Operation Twist and started QE3. So what's surprising about this low long-term rate is that market expectation is set for Federal Reserve to increase federal funds rate from the current zero lower bound in mid-2015, as well as we know that QE3 finished by Federal Reserve in December of 2014. Our current expectation as BBVA Research baseline is that Federal Reserve will increase its federal funds rate. The first liftoff will occur in September of 2015. From the economic environment perspective, what we're expecting that is moderate pace of economic expansion will continue, as we've seen in the past several years. 2015 GDP growth projected to be around 2.9%. The labor market will continue to improve with 5% unemployment by the end of 2015. As we all know, there's a downward pressure on headline inflation rates from the very low energy prices that we're observing. However, the interesting part is that we don't see the pass-through to the core inflation, and the core inflation for CPI is expected by us to stay at 1.6% for the year. This is good news for Federal Reserve. Because of that, we don't expect that Federal Reserve will change its timing for the federal funds liftoff. Now, as we can see, the 7 years of unconventional monetary policy charted together with 10-year Treasury note yield on slide 4. What Fed is expected is to kick off the policy normalization in 2015. And as we talked about in a previous slide, the current low rates didn't really occur since the Federal Reserve started to change the balance sheet and switch to long-term securities, as well as additional long-term securities and long-term securities and mortgage-backed securities with QE3 in September of 2012. Now, what's interesting is that the 7 years of unconventional monetary policy did not really affect volatility for long-term rates. As we can see of 10-year Treasury yield volatility, both measured by the index, by CBO, as well as our volatility measure, shows that the 10-year Treasury yield volatility didn't really change since the 90s. It's about the same. So how can we explain the current low long-term rate environment? What we observe is that there are many structural changes in the market dynamics for the long-term rates, as well as structural and cyclical factors that are affecting macroeconomic fundamentals like expected lower potential output and low inflation rate in the long run that are affecting the current interest rate environment for the long rates. What we find, there are several forces behind the current long-term rates, such as low inflation expectation, as well as reduced monetary policy uncertainty and reduced duration risk, which is really an outcome of supply and demand imbalance in the Treasury securities market. So our really conclusion is that downward pressure on long-term rates is going to stay. And it's going to stay because all the structural issues, as well as the forces behind the low term premiums that we talked about just a second ago, they're going to dissipate very slowly. We don't expect that structural issues to correct quickly in the long run. If we look overall at the common term premium among all the developed nations, as measured here with the common trend for 10-year bonds for US, Canada, Germany, UK, Japan, and Australia, overall since mid-90s, the term premium for all these nations sloped downwards. However, what's further noticeable is this right now is the second lasting episode for US 10-year Treasury yield term premium to be in a negative territory. So the difference, however, right now is that both term premium and inflation expectations have declined when in a previous time, if we can see from the chart on the right, there was a decoupling between the term premium and inflation expectations. As this you can see on the chart on your right, the both episodes of negative term premium together with the market expectations of implied 10-year spot inflation rate on slide 8. Now, another thing, aside of a low expectation of inflation risks, the reduced monetary uncertainty also contributes right now to the negative term premium. And what really happens that since the taper tantrum episode, Fed learned to avoid market surprises. So what we've seen right now from the Fed communication and Fed speak is Fed communication have been crafted to align expectations with the Fed's future reaction function, as well as from the recent March FOMC projections of the policy firming expectations, we can see that the FOMC expectation also for the pace of firming declined, which made it closer to our BBVA research projections, but much closer as well to the futures market, which are much lower, even below our expectations. This is well said by the former Governor Stein, who is not anymore in FOMC governor, but in his interview with Wall Street Journal, he mentions that to avoid unsettled markets, Fed officials have an incentive to stick to the path that investors infer. So we can continue to expect that Fed's implied path for the future rate hike is going to be closer to market expectations, and that will induce reduced monetary uncertainty in the future. Another factor contributing to the low term premium is the supply and demand imbalances, which also basically resulted in a decline in duration risk. What we can see here in the chart that the duration risk for 5-year, 7-year, and 10-year term premiums are basically the same. And we can see compression of term premium curves in medium to long run treasuries. This is explained, as I said, with the decline in duration risk. And the channel for this explanation is portfolio balance channel, where supply and demand imbalance is the outcome of reduction in the aggregate amount of long-term bonds, which shortens the average maturity of outstanding securities, and that by itself in a portfolio balance channel results in a decline of duration risk. So if I go back to the previous slide, slide 10, you can see the term premiums charted on the left, and you can see that all of them are compressed for 5-year term premium to 10-year term premium are compressed to the same levels. Same negative levels, actually. So what is behind the supply and demand imbalance in the treasury market? You see that the Fed maintains their investment policy, and Fed is not going to deplete its 2.46 trillion holdings of securities. If I may ask, can you please mute the speakers? So currently, the Fed holdings of securities are about 19.6% of total outstanding treasuries and 15.1% of GDP. As we can see from the chart on the right side, Fed holdings of treasuries as a percentage of total holdings of maturities. The maturities of 5 to above 10 years are combined to 52% of total maturities held by Federal Reserve. Another demand side pressure for Treasury market is U.S. debt that has not lost its appeal to foreign investors, so we continue to monitor actions such as flight to safety and flight to quality from the foreign markets. The U.S. debt is more attractive in comparison to its counterparts. It offers lower deflation risk and greater promise for economic growth if we compare to other developed nations. 2014 holdings by the rest of the world account for 48% of U.S. debt. And if we combine the rest of the world together with Federal Reserve holdings, it actually combines to a total of 70% of U.S. debt issuance. Now, there's more demand-side pressure that is a result of current regulations in a post-recession environment. New financial regulations on liquidity rules increase domestic pressure on the demand by banks and pension funds. So liquidity rules have steadily increased for banks' demand for treasury securities and also led pension funds to de-risk their investment by moving from more heavily into low-risk government bonds, and we can see that on the right chart on slide 14. So our overall expectation, as we saw from the previous slide, is that downward pressure on the long-term rates will remain. Long-term premium environment will stay as it is because inflation risks are not expected to pick up because of long-term structural shifts in inflation composition, and we covered that topic a year ago. I will be happy to refer you to the brief on inflation that we've written in February 2014. Reduced policy uncertainty environment will continue through the course of the Federal Reserve exit, because Fed will maintain policy transparency, and we expect Fed to maintain clear communication as well as federal pass of federal funds rate increase will be close to the market expectation of futures on federal funds rate. Duration risk will also maintain its downward pressure because of the supply-demand imbalances. The supply side pressure will stay because debt issuance will stabilize around year-over-year growth rate of 3.5%, and we'll see that chart in the next slide 16. And the demand side pressures will also remain because domestic regulations and foreign demand will keep upward pressure. As we talked about, flight to safety and flight to quality are expected to continue towards U.S. Additionally, the decoupling between the policies right now of Federal Reserve and European Central Bank will likely result in additional flow of funds into U.S. market. So, as we said, the downward pressure on supply and demand imbalances will remain. And as we talked about it in a previous slide, slide 15, we can see that the supply of debt issuance is going to stabilize in the future. This is the projections till 2024 at 3.5%, while gross federal debt as a percentage of GDP is going to increase and then steadily increase after 2017, but still at a higher level than now, expected by 2020. Now, another interesting factor is the aging population, which becomes a big factor behind the potential GDP for developed nations. And as aging population becomes one of the pivotal structural obstacles for the potential growth, the share for foreign holders of U.S. debt is expected to continue to grow because, as we can see on the chart on the left, this is median age growth from 2010 till 2080. I know it's far into the future, but we can see that the U.S. medium age is lower compared to the other developed nations as Europe and Japan, as well as China, is going to increase above US in its median age. So what this means is that US will be considered as a younger country compared to the other developed nations, and this will bring consistent flow of capital to the younger country, which will be the provider of future consumer goods. So the pursuit by aging population of high-quality safe investments will increase the demand for US debt and will lower future long-term bond rates even further in the future. So this is a type of downward pressure that is expected to remain going far into the future. Next, we're going to talk about our yield curve forecast in three different scenarios. We're going to talk about, first of all, our baseline scenario where 4-year average real GDP growth is expected to be around current 2.9%. The consumer price inflation is, for a 4-year average, is expected to be 1.8%, and federal funds rate by the end of 2018 is expected to be 3.25%, which will be a 300 basis point increase over the current federal funds rate target. So we're going to compare our baseline scenario to two different scenarios. One of them is a steeper increase of federal funds rate by Federal Reserve and how that will affect the yield curve as well as the 10-year note yields. And the second one is a risk of low inflation with the 4-year average inflation rate around 1% instead of the forecasted 1.8%. So what we can see is overall, even though the long-term rates are expected to increase together with the federal funds rate increase into the future, the increase is going to be milder. When we look at the scenario when there's a 125 base higher policy rates increase, this results in about almost equivalent increase for 10-year yields and also results in 45 basis points flatter yield curve. Now, the risk of low inflation scenario results in about like 63 basis points decline in the yield and also flattens the curve by 50 basis points. What's remarkable is that even in our baseline scenario, and as well as in the other two risk scenarios that we're exploring, the yield curve is expected to be much flatter compared to the historic mean of the yield curve. And this is also very well visible from the current 10-year U.S. Treasury yield futures. As you can see, even compared to the March of 26 when we published our study on a low interest rate, yesterday the futures for 10-year U.S. Treasury were lower, and by June, basically second half of 2016, the futures expect the 10-year yield to be below 2.9%, which is very low in historic terms. What we also find that both inflation and federal funds rate are far more relevant than economic growth for future paths of long-term yields. So we also considered a scenario of high growth or low growth for GDP, but it did not affect much the overall path for 10-year yields as the yield forecast. So our overall expectation from this study is that there will be, of course, some change in 10-year treasuries as federal funds rate starts increasing its policy rate from zero lower bound. However, the increase for long-term rate is going to be milder, and the yield curve is going to be flatter in the future. So structural and cyclical factors that explain recent historic low levels on long-term rates are unlikely to dissipate, as well as improved fiscal conditions, new financial regulations, demographic changes that we talked about, elevated global uncertainty will offset the absence of additional Fed assets and will keep demand-side pressure on long-term rates. So the outcome is going to be mild long-term rate increase and flatter yield curve forecasts, even when accounting for macroeconomic factors and short rate liftoff. Now there is a different possibility where the risk can come to our current scenario. So small likelihood of upside pressure for 10-year or long-term rates is of course possible, and the small likelihood of upside pressure on long-term rates can arise from increase in aggregate amount of bonds available to private investors. Now these scenarios are not very likely. The probability of these scenarios is very low, but there is a possibility that domestic loosening of supply, for example, Fed speeds up the balance sheet normalization and decides to start selling long-term treasuries in difference to the current commitment to hold it to mature. There's even a lower possibility to the second case where this effect could be augmented if foreign current central banks fall under financial distress and need to sell off their U.S. Treasury holdings. So the upside pressures on long-term yields, if it occurs, the probability is very low, but it will be a supply side effect, the loosening of supply in the Treasury securities market. So on this note, I would like to finish our presentation on long-term rates.